Welcome to Industry Insights. Thank you for joining us today for Real Estate Taxes. Maximize the benefits of your entity structure. I am going to jump right in and introduce today's special guest, Tony Watson. Tony is an enrolled agent who focuses on providing personalized financial guidance and tax preparation services to both individuals and businesses. If you were joining us back in March, you already know what an expert he is in this field, not only specific to real estate, but so many other industries as well. And as a federally licensed tax practitioner, he helps his clients ultimately make sound financial decisions to ensure all eligible deductions are received when it comes tax time. On the heels of the 2021 tax day, we thought this would be very apropos. So he works with clients in multiple industries, like I mentioned. And in addition to his one-on-one client work, Tony's also a keynote speaker for Robert Hall and Associates. He's spoken at hundreds of trade organizations throughout California. His dedication to his clients has also led him to win the Glendale Reader's Choice Award for Best Tax Preparer in 2016. So I could go on and on with his accolades, but I would love to have you help me give Tony a warm welcome as he's going to share his input on maximizing the benefits of your entity structure and the other impending changes happening today. So taking the mic with Tony is our very own Bill Tessar. And as you know, Bill is our president and CEO at Civic. He has over 30 years of mortgage industry experience. If you have joined us month over month for Industry Insights, you know all about Bill's background and what a visionary lending leader he is. Industry Insights started, it stemmed from Bill wanting to just have real talk in the industry. Real talk when everybody else went radio silent. And it wasn't talk about Civic. It was, let's talk about what's going on right now and how it affects all of us and our businesses. So we all, I think I can speak for everybody to say how much we appreciate you starting the dialogue that has continued to this day. Bill previously served and founded 3 different mortgage companies, served as president, resulting in a funding volume exceeding 35 billion. But for Civic specifically, he has done some remarkable things, especially this past year. We have reached 10,000 loans funded. We surpassed $4 billion funded and $1 billion in funding in 2020 alone, which through the pandemic was just remarkable. He is a Glassdoor top CEO. He is a Housing Wire Vanguard Award recipient, and we are ready to tap into your knowledge, Bill. So without any further ado, welcome to our president and CEO, Bill Tessar.
Thank you, Gina. I always say, like, when she does an introduction, if she could do that at my house before I come home from work every day to my wife, I think things would be super smooth and she'd appreciate me a little bit more than just working hard every day. So Gina, maybe like every other Monday you swing by and just from the door yell out, okay, the Vanguard husband of the blah, blah, blah. I don't think it would actually be received the same way, but we should try it just once.
You got it. You got it.
No, but thank you, Gina and Tony, and then everyone else who's a part of this. I shared this truth the last time Tony joined us a few months ago. And I think in business, a very close second to making money is the energy and guidance around how to keep it. So when you think about having a tax pro or team on your side, you're talking about creating 30 to 55 cents of every dollars you make in savings simply by understanding the tax code. What's not so simple is the tax code 74,000 pages right now, and there's been 4,500 changes in the last 20 years to that code. So what I love about Tony is he has a tremendous amount of reference of the material items inside that code. And better than that, he explains it in like super easy to digest form. And I think the last time he spoke, I got more emails and text messages in and around those two simple things. And all I said is, yeah, you're right. You're right. You're right. Gina, let's get him back here. My goal today, like every other industry insight, is that every one of you walk away with one nugget that either improves your financial situation as you sit or is part of your plan in moving forward. So before I get started, I did find a tax quote, which I thought was awesome. It says, you must pay taxes, but there's nothing in the law that says you got to leave a tip. And I think it's appropriate, right, Tone? I mean, really.
Very appropriate. Yep. Oh,
So Gina said a few moments ago that we covered a number of items in the last time we spoke, but there were some remaining chads that like were heavy. And so I think what Tony and I decided was to break it down really into three categories. The one is probably the burliest, which is really the power of incorporating. And there's so many different levels of that, Tony. So I thought, like, for me, let's start with whether or not incorporation is right for our real estate investors and how they determine that. And then from that, there's a number of things I want to ask you, if you don't mind.
Sure, absolutely. And this is one of the many topics that I discuss in webinars and pre-pandemic in-person webinar or in-person seminars. And it's near and dear to my heart. It's been probably a key factor in the growth of our firm and the growth of my personal clientele. And it's the ability to teach people and help people through the process of incorporating their businesses. And a lot of people get hung up on some minute details that they shouldn't really worry about, because remember, all the worry really lands on your tax preparer, right? So when you talk about real estate investing, if we can break it down into just very two simple categories, either the long-term investor or the short-term flipper, right? And the government views those two professionals within the real estate industry differently from a tax perspective. For instance, if the government sees that you're flipping 3 or more properties on average each year, or at least within 365 days, they're going to deem you to be a property dealer and say that you're a self-employed income earner, meaning that all of your short-term property flips are not only subject to federal and state income tax, but they're also subject to Social Security and Medicare tax. Whereas the long-term investors, they don't have self-employed revenue. That's one of the greatest things about rental income, is that it only settles up with Uncle Sam in the state of California or whatever state you own the rental properties in. So we need to break it down first into those two subcategories and figure out where a majority of that income is being generated, or what kind of income is being generated. For the long-term investors, the most common entity to use for protecting those large depreciable assets is the LLC. LLCs, if I can leave you with one piece of information about an LLC, is that it saves you absolutely nothing in tax. And I'd say that that's probably one of the biggest pieces of misinformation, is that people feel like if they incorporate, they're going to save all of this money in tax, which with certain entities that might be the case, but not with the LLC. The LLC does exactly what its name entails. It limits liability, and that's it. And so with rental income, with rental properties, the large asset, probably the largest asset that you and I will ever own in our lifetime, either commercial or residential, we want that protected. We want that added layer of asset protection, which happens to be provided by the LLC. And of course, we have our insurance policies and all of the other ways that we protect ourselves, living trusts, irrevocable trusts. But at the end of the day, the LLC is the most common entity used to protect assets separately from our primary Social Security numbers. But remember that LLCs provide no tax benefit. Now, when I say that they provide no tax benefit, it's not that we're talking really about federal and state income tax in this case. We're really talking about this nasty self-employment tax that most self-employed income earners pay at the end of every year. Self-employment tax alone is 15.3%. So imagine that out of all of your income, you're getting ready to cut checks on your liability to the government. You're sending a check to IRS, you're sending a check to the state of California, and you figure, okay, well, my tax rate is about 32%. And then all of a sudden, your tax advisor says, well, you got to also contribute to Social Security and Medicare, and that's an additional 15.3%. So you can imagine how your stomach would feel after you're not only paying 32%, let's say, in federal and state income tax, but on top of that, you're having to pay an additional 15.3% because you are self-employed. So it's really important for us to determine what kind of revenue you have. And that's what, Bill, last time I spoke, I feel like that maybe I didn't spend enough time on that particular part of this conversation, because that's really the key factor in choosing what type of entity to use for any sort of real estate investment, like long-term investments versus the short-term flippers, who would be subject to that additional self-employment tax. The S corporation is going to be the mecca of incorporated entities, or tends to be the mecca of incorporated entities, because it is a known fact that the S corporation can actually save people tax. But once again, what type of tax is it saving you? Because the LLC, if it saves you nothing in tax, and the S corporation would save you in tax, it's not actually saving you any federal or state income tax, but what it is helping you reduce is the amount of self-employment tax that you pay, but only if you are a property dealer. So the conversation that I have with my clients is, okay, well, what do you do in real estate? Do you buy and hold, or do you buy and sell? And buy and sell, meaning what I really want to figure out is, do you buy and sell within 365 days? And how many times do you do that each 365-day period? So that's just kind of diving in and wetting the palate a little bit. That's probably the base of this conversation. And I'll stop there and see if there's any key points that.
Yeah, Tony. So first of all, so if somebody, generally speaking, acquires a property, rehabs a property, markets the property, enters into escrow, and let's say that entire duration is in or around 10 or 11 months. Is there a material difference between that and making it 13 months, taking your time, adding a couple months and looking at more of the long-term perspective? Can you talk about that?
Absolutely. As the code stands now, if you hold a property for 366 days, literally 1 year and 1 day, your capital gain tax significantly drops. Remember that if you buy and sell within a year, it might not be active income. It might not be the type of income where the government steps in and says, well, you are a property dealer. Because remember, you have to flip like 3 or more properties within 365 days in order for the government to even consider you to be a property dealer, subject to self-employment tax. But if you buy and sell a property under a year, that's short-term capital gain. That is subject to ordinary income tax rates. If you're in the 32% bracket, you pay 32% on the short-term capital gain. Just by holding that property for 1 year and 1 day, in this scenario, you drop your tax rate from 32% down to 15%, or depending on your personal adjusted gross income, possibly 20% long-term capital gain. Even at the higher 20% long-term capital gain, that's still 12% less. Once again, in this specific example, that's still 12% less just by holding the property for more than 1 year, more than a 365-day period. So I have a lot of clients sometimes where they'll get to that 11-month period and we'll hop on the phone, we'll do some tax planning, and I'll say, well, is there any way that we could delay the closing of this property to at least a year and a day, just so that we can drop that capital gain tax from 28, 32, 35, 37% per se, all the way down to 20 or maybe even 15% long-term capital gain tax. That's federal. And then state is a straight up 9.3%. California, for instance, the highest tax state in the US, there's really no relief for being under any specific income bracket. California gets paid their piece of the pie at 9.3% on short-term and long-term capital gain tax.
Hey, Tone, I might be jumping ahead, and if I am, tell me and we'll come back to it. But so you've talked about there's the differences of the tax. What about the differences of writing expenses through the LLC, S Corp, C Corp? Any differences there on what is and isn't acceptable that you can write through auto, business promotion, marketing, travel, lodging?
So, I mean, LLCs and S corps, they're both businesses, right? I mean, from a bird's eye view, if you have an LLC, an S corp, or even a C corporation, or even an LLP, a limited liability partnership, you're telling the government that you are trying to protect something, protect a business, protect an asset, whatever that is. So from a bird's eye view, everything incorporated tends to be business or active or even non-passive or passive income. But at the end of the day, when you have the different types of entities, deduction-wise, most things will stay the same amongst the LLC, the S corp, and the C corp. The major change, though, between the LLC, the C corp, and the S corp is the reasonable salary compensation. Because as an LLC, whatever your profit is, let me just throw out some figures. Let's say that your profit is 100 grand. Let's say you buy and sell a property, you got 100 grand in net revenue. Under an LLC, if that is self-employed income, if you're a property dealer and that's subject to all of the tax rates that an LLC is subject to, you'd be paying federal, state, and self-employment tax on 100 grand. And once again, I'm being very vague.
Pause there, Tony. You're paying those three taxes on that event, or are you paying those three taxes net of all your expenses?
So we're assuming just for the time being that 100 grand is after all of your expenses, just to give you an example of how this works. So let's assume that I've already written off everything under the sun. I've written off my mileage, my cell phone, my legal and professional fees, all of those expenses. And I'll dive into that in more detail in a second here. But let's assume 100 grand is already taking that all into account. LLCs will pay the max tax rates. Like I said earlier, LLCs save you nothing in tax. The S corporation, however, on 100 grand, you get to split that $100,000 profit into two different numbers, two different figures. One is a reasonable salary compensation, and the other is flow through profit. And the reason why this is important under an S corporation and compared to an LLC is that if you're going to pay all of the tax on the full 100 grand under an LLC, you're thinking, okay, well, that doesn't sound good at all. I want to minimize my liability, right? Well, by flipping your self-employed income business or property dealer business into an S corporation, you're not really saving federal and state income tax because your profit under an S corporation is still 100 grand, right? No matter how you split it, when you add the two numbers up, it's going to be $100,000. But under the S corporation, what you get to play is a game called the reasonable salary game or the reasonable salary ruling, which allows you to pay yourself a minimum reasonable salary of as low as 35% of your net revenue. Average is about 40%, but let's say 35% just for ease of calculation. 35% of 100 grand is 35,000. Easy calculation. That's your W-2 that you paid yourself as an employee of your own corporation. Because as an S corp, you're not really self-employed anymore, right? You're a shareholder, primary shareholder of a corporation, normally 100% owner, and you are required to compensate yourself as an employee of your own corporation. Now, this is where the real kind of fun happens. You pay yourself a $35,000 W-2. You get to write yourself off, right? So 100 grand minus 35 grand gives you 65,000 in leftover profit. And what you've just achieved here, remember, compared to the LLC where you pay tax on the full 100 grand, under the S corporation, you've split your profit into two figures, the $35,000 W-2, $65,000 K1 profit. And what you've avoided on the K1 amount, this 65 grand, what you've avoided, not evaded. Remember, tax evasion is illegal, tax avoidance is not. So let's all properly avoid tax. And on 65 grand, what we've properly avoided is 15.3% of Social Security Medicare tax. On the 35 grand that you paid yourself, that's a W-2. You pay Social Security, Medicare, state disability, unemployment insurance, all of the payroll taxes, right? Which is also self-employment tax. They're the same thing, except now only 35 grand of your $100,000 profit is subject to Social Security, Medicare tax, and 65 grand has completely avoided 15.3% of tax. That's about $9,200 in tax savings right out the gate, simply by filing as the right type of entity. I could go through a million scenarios, but I think you get the gist of how that all works. And deduction wise, between the LLC, the S Corp, and even the C Corporation, I mean, your mileage, your cell phone, your online charges, travel, meals, entertainment on the state side, not on the federal side, unfortunately. We'll see what changes are on the horizon for 2021 and 2022. Under the corporation, you can actually pay yourself rent and rent out a room inside of your home back to your corporation. I mean,
what about SEPs? SEPs, right? 401k, SEP, IRA, any of that?
401. So the great thing about the S corporation, once you become an employee, is you can not only have the employee 401k, but then your company can also match up to 25% of your W-2 compensation with a max contribution of like 57 grand. And it changes by about $1,000 each year. So as you can imagine, if you're making all this money flipping property, and this is, let me just kind of sidetrack really quick here. This is the main reason why the general public, the GP, hates corporate America, right? We all know what the media talks about. We all know what the government, or not the government, what the media stations put out, in front of the general public. And they say, look at all of these wealthy individuals paying very little tax. Well, understand that most of the real estate tax benefits, I had a at length conversation with a client yesterday about this. The real estate tax code has been around since the early 60s. So 1962 was when a majority of the really beneficial real estate tax codes were brought into fruition. That's when they were developed and thought about. So they've been around for a very long time. And so people have been able to use these benefits, to save money, to retain wealth, and not pay excess tax to the government. Remember, through proper planning, we all have an obligation to pay tax, right? But not a penny more than that obligated amount. And the way that the wealthy of America do it is by utilizing their accountants and entity structures to shelter revenue. And those benefits have been around for a very long time. The S Corporation is not a new entity. That's been around since, I think, 1972. So if you have been filing as a sole proprietor or a single member LLC for a very long time, and it's never been a conversation that you've had with your tax advisor about whether or not an S corporation is better for you than an LLC, maybe it's time you sit down and have that conversation. You could be leaving a lot of money on the table simply by filing as the incorrect entity or not filing as an entity altogether.
And Tony, limits on what they can be writing off if they're just staying sole proprietor, W-2, wage earner, What are the limits on that today?
So as far as limits, a lot of people get stuck on this. Well, what can I write off, or how much can I write off? Not what can I write off, but how much can I write off? I have to tell you right now that the sole proprietorship, the Schedule C, this form on the individual return, known as the sole proprietorship form, that small business form runs close to a 75% chance for audit. Out of all of the forms that you file on your individual return, the in-home office form and the Schedule C form are the two highest audited forms on the personal return. So when you talk about a limit of deductions, if you make 100 grand, you can write off 100,000 in expenses. No problem. If you have legitimate $100,000 in expenses, you made no profit. The government, the tax code allows you to write off everything that is ordinary, necessary, and legitimate. I mean, sometimes people will make 100 grand and spend 500,000 in startup costs. And at that point, that loss is still very much a tax write-off for you, but the risk for audit is much higher because you're filing it on a sole proprietorship form. If you have no revenue, so if you're just a startup business, which we know in California, gosh, dating back to the early .com boom, we know that startups are more common here in California than anywhere else in the US. If you have no revenue, you can write off up to 5,000 in startup costs, 5,000 in organizational costs for a $10,000 loss, 2 years running. And after 2 years, the government deems your business a hobby if you have no generated income, because what generates no income and only has expenses? Well, to the IRS, that's a hobby, right? So after that 2-year period, you have to suppress the loss. You don't lose it, but you have to suppress the loss and carry it forward until your business actually starts to generate revenue.
So I should stop there for a sec, Tom. What about people that do start a corp? They have revenue, but they have exceeding expenses that show a loss. So in that same example, one of these investors buys a piece of real estate and it ends up producing they missed the market and they lost 25,000 on it. How much additional expense can they write off and show on that return?
Sure. So 2 examples, and I hate to do this, but I got to break it down into 2 examples. So let's talk about the person who buys a rental property and holds it for more than a year and loses on it and decides to dispose it, or the person who is flipping the property, buys and sells it at a loss within a year. Hopefully that's not you, but I mean, hopefully that's not anybody in today's webinar. But the long-term rental investment is really, really unique. There's a certain part of the Internal Revenue Code called 4797, and the 4797 business loss is kind of like the S corporation. It's the mecca of the tax industry. It's been around for a very long time, and it is a true realized business loss. Now, what I mean by that is that if you buy a home and you own it for, let's say, 3 or 4 years, let me use dates because this will go really well. Let's say I bought a home in 2006 or 2007, right at the peak of the market, right? And then I ride that train all the way down to 2009, 2010. I owe way more on the property than what it's worth. I can only get pennies on the dollar for the property in 2009, 2010. So I was a victim of the recession, let's say in 2007 to 2010. If I bought and rented out that property, and let's say that at the end of its life, I had a $400,000 loss on the property. Well, if I lose on a long-term investment, 4797 kicks in, this part of the Internal Revenue Code that allows a real property loss at 100% deduction on the year or in the year of sale, meaning that I have to dispose of the property in order to actually realize the loss. And that doesn't matter if I'm a real estate professional. It doesn't matter if I'm a doctor, if I'm unemployed. At the end of the day, if I lost that kind of money on a long-term rental property investment, Section 4797 kicks in, allows me to fully deduct those losses to offset all income. So imagine if I'm a brain surgeon and I bought a home in 2007 at the peak, sold it in 2010. I got $1 million W-2. I lost 400,000 on the real estate deal. Obviously, that was a bad deal. I bought it the wrong time, sold it the wrong time. Obviously, if I just held on to it for a little bit longer, maybe rode the train back up to whatever the original value was. But imagine $1 million W-2, a $400,000 loss with no limit, with not being subject to any limit because of 4797. That $400,000 loss in my income bracket as a brain surgeon would save me close to 50 cents on the dollar in income tax. So I get a pretty nice tax shelter for that because of the high income bracket and the no restriction on loss if I truly, truly lost money on the long-term asset. Short-term assets are different. When you buy and sell on the short-term losses, short-term capital losses are subject to limits. In fact, when you talk about capital losses versus 4797 losses, capital losses can only be offset by like-kind income. And I don't want to get too into detail because I know that I'm understanding all of this, but I know that some of this might just be flying past your ears. So just understand that short-term is going to be treated much differently than long-term rental investments. And
But in addition to those losses, Tony, can they run their other expenses through? Sorry to interrupt you, like all their auto and marketing and all that, because they had revenue. You gave an example of no revenue, max 10 grand. But now they have revenue, even if that revenue results in a loss, can they run their other expenses through in that year as well?
So you see two common ways that business owners will do this. The rental property owners will tend to set up a separate form, a Schedule E operational form, I call it. It's not called that under the Internal Revenue Code, but let's say you have your rental property forms on your individual return. You'll set up maybe an additional Schedule E, and that's where you'll run your mileage. Or if you bought a car, you'll run your depreciation on the vehicle. You'll run your internet, your supplies, your equipment purchases, all of that stuff, because those were your operational costs pertaining to your real estate investments. That's for long-term rental investors. For property flippers, it's different. You're not going to put it on a form Schedule E. You're going to put it on a form Schedule C because it's an active business. You're a property dealer at that point, or you could even manage your own properties and set up a Schedule C and pay yourself a management fee. I don't see too often people doing this, because then you're converting rental income into self-employed income, which is subject to the additional type of tax. But if you're in a high enough income bracket and you need to contribute money to a retirement plan, very, very unique ways to create these scenarios where you actually manage your own properties and create this management company that entertains the idea of buying vehicles and setting up in-home offices and 401ks and IRAs, maybe even putting your children on payroll, which is a great way to transfer wealth. Instead of being subject to this estate tax if you're over $11.3 million or $23 million if you're married filing joint. So all comes back to proper tax planning. Some of you may benefit from that. Others of you might not, but it really all comes down to what your individual scenario is. So to answer your question, Bill, the way that a rental property investor would set that up, still all of those are great tax write-offs. Like I said, the vehicle and the legal and professional, all of that stuff. It's just a different way to write it off than the active property flipper or property dealer would. But great overall deductions.
So comment and a question. I mean, if you're all listening, I mean, think about it. If you do nothing, remain sole proprietor, you're gonna lose some protection. You're going to lose a lot of tax write-off opportunity, and you're going to lose a lot of tax benefit opportunity inside either the SC or LLC. What about cost and timing, Tony, of these things?
Sure.
The three of them.
During the middle of the pandemic, I can't even stress. Yesterday was a very unique day. It was like oh gosh, what's the feeling I want to describe yesterday? It was like the end of and it's not even the end of 2020's filing season. We still have extension filing season, but it was the end of probably the longest tax season in my career. I've been doing this for, gosh, going on 17 years now. And yesterday was just a really happy day for probably a lot of tax preparers across the US. But timing for incorporating during the pandemic was much different than it will be in the upcoming months. There are still major delays. In fact, the government, I had some stats available for us earlier, and I think I remembered them pretty accurately. The government's still about 2 or 3 million documents behind in processing from the pandemic. So make no mistake, if you're filing an incorporated entity or filing for incorporation, you're looking at a non-expedited time frame of about 5 to 8 weeks, meaning that if I file articles today, I probably won't get the hard documents, the actual tangible articles of incorporation, the ones that I can hold in my hand, for another 5 to 8 weeks, depending on how quickly California is picking back up and or processing paperwork. Your EIN number, you could go online right now to the IRS website, apply for an EIN number, and within 5 minutes you could have one. So the EIN number, no problem. That's what allows you to go and set up a bank account, so on and so forth. But the articles of incorporation, the documents that protect your assets separately from your personal assets, about 5 to 8 weeks. California will charge you an expedite fee, runs about $350 to $450. That'll get you up and running in 7 to 10 business days. During the pandemic, that was about 2 to 4 weeks. So they are catching back up. The government's catching up. California's catching back up. We're going to see some major expediting changes at the state level in the upcoming months. But then we have this whole new internal revenue coming in that California has to either conform to or reject. And so we'll have that whole thing blocking up the pipeline again. But what we're catching up. So time frame is, if you need that LLC, like if you're a property flipper or you're acquiring a property, you're going to close in the next 3 weeks. Yes, you can get an LLC up and running in time to acquire that property under the LLC name and the EIN number. So just as a quick note for all of you who want things to filed expeditiously.
One last question on this subject before I go to the next one. Any reason why anybody who deals in real estate, the buying and selling short or long term, should not be incorporated, should not consider an LLC? Any reason at all?
Yeah, I mean, the one main benefit of the LLC, once again, is legal or asset protection. And so if you take a look at your renters or the people who are owning a business out of your commercial property, and you figure that there's a certain level of risk and liability that you operate at, and you feel like, well, I don't really know these people. They seem, I'm not going to call them shady, but let's say you just have a bad feeling, or you have other assets that you own that you want to separate from this particular asset that you're trying to protect. LLCs are great for protecting that asset separately, right? So you got to look at the risk and liability. As far as the tax benefit, you need to hit very specific numbers. I just want to say incorporating is not right for everyone, okay? Just because I'm here giving you all of these benefits doesn't mean that you should all leave this webinar and say, hey, I heard this crazy guy, Tony Watson, on this webinar today. Tell me that I should go incorporate. That's not what I'm telling you. I'm telling you that this is a good conversation to have with a licensed advisor who's going to point you in the right direction. Hey, right now is the right time to incorporate because of X, Y, and Z. For self-employed individuals, your net profit, your net profit. So after all of your expenses, you need to be at or above $45,000 to $50,000 in profit in order for the incorporated S corporation to save you more than it's costing you. And that's one of the main concerns for people. It's like, okay, well, this all sounds great, but what is it going to cost me? Well, state of California has the highest filing fee in the US. I call it a parking ticket because it's a parking ticket for parking your business in the state of California. So you got $800 right out the gate, whether you made a profit or not. You could have lost $1 million in your business. You still got to pay California's $800 filing fee. So whether you lost, broke even, made money, $800 parking ticket to the state of California. Then you've got to file the tax return, right? So industry average for any sort of entity could range anywhere from $500-600 to sometimes if you're with Ernst & Young or Deloitte, you could pay $5,000, $10,000, $15,000, $20,000 for an incorporated entity filing, depending on the complexity of the return. So once again, at 45 grand, $45,000 to $50,000, if you're self-employed, that's going to save you about $4,000 to $5,000 in tax. And you figure that if industry average costs me $2,000 to $2,500 to file, I'm not only saving myself the cost by incorporating, right? I'm saving that much in tax, but I'm actually keeping about $2,000 plus more of my income. I'm retaining my wealth because of utilizing this entity structure and playing the very specific games that it allows me to play. Mainly and specifically the S corporation though. C corporations are completely different entities. Those are very unique entities, normally for businesses that have over 100 shareholders or very unique and specific syndications. That would be one of those consultations where we would have to dive more into detail about why a C corp would be better than the S corp or the LLC in your particular situation.
Tony, what about, you mentioned earlier the capital gains, and there's a lot of talk. I've been in a dozen roundtable discussions about the potential changes in the capital gains code with the new administration. Have you gotten any insight, feelings, or thoughts in or around that? And if so, what impact that could have on the real estate market or the way real estate investors approach the market?
Sure. There's a lot of speculation at the moment, a lot of fear. People are making very rash decisions based on speculation, based on just theory of what's going to change. Right now, the Biden administration, under his proposed new revenue code, it's trying to change capital gain tax for the wealthy mostly. He's kind of focusing on a $400,000 threshold and above. Some other unique changes deal with, the $500,000 threshold and above. But capital gain tax long term could actually be subject to the highest tax rate of about 43% in some cases. For individuals who make under a certain level of income, tending to be under 400,000, the capital gain tax rate should stay fairly the same. The government, just to give you once again a bird's eye view of things, the government loves to phase people into a benefit and phase people out of a benefit, right? So at $400,000, this is going to be kind of and I believe it's going to be taxable income. Don't quote me on that. It might be adjusted gross income, but I believe that it's taxable income that they're going to go off of. At $400,000 in taxable income, if you breach that, you start to phase out of the lower capital gain tax rates, which stand at about 15% right now federally, 9.3% state. However, if you make over $250,000 adjusted gross income, you're subject to 15% federal plus 3.8% net investment tax. That's you covering free healthcare for individuals here in the United States. If you are above $450,000, you're subject to 20% long-term capital gain plus 3.8%. So right now, the highest capital gain rate long-term that you could pay currently before the new tax code changes is about 23.8% federal, 9.3% state. The federal government is talking about jumping that all the way up to 37%, right, which is the highest tax rate, or I'm sorry, 39.6% plus 3.8%. So you're looking at 43% federal alone, plus 9.3%, which puts you well above 50% of your overall income in tax. Now, there will be exclusions from the sale of these properties. So when you sell it outright and you don't do an exchange, which we'll talk about in a second, if you sell it outright, there will be a deductible amount you can back out from your gain. And what I'm hearing is it can be anywhere from, I think, 50% of your overall gain that you can back off. But once again, there will be phase in and phase out thresholds for this, where you can back out half of your gain and then you pay the 50+% tax on whatever the remaining amount is. I'm going to tell you right now that probably won't pass, but there will be a form of that change that passes. We just won't know just yet. But don't go out and sell any capital assets, long-term assets, without talking with your tax advisor first. I do not want you to start dumping assets out of fear that the estate exemption is going to change, that capital gain tax rates are going to change. Because remember, as long as you hold the asset, you're not paying any capital gain tax, right? So if you hold it for another 4 to 8 years, and we have a new president in 4 to 8 years who comes in and changes it all, then if you had sold it before this, I mean, they could repeal all of this, just like Biden is repealing a lot of the 2018 tax code. So once again, do not make rash decisions. Long-term capital gain will essentially become like short-term capital gain, but really will only impact in a majority of the people who will be impacted are the individuals making over $400,000 a year.
So I think you bring up a good point. So Civic's original founding company is the largest purchaser and flipper in the nation. They, even in today's market, they're purchasing, fixing up, and flipping about 450 homes a month nationwide. And I sat in a roundtable with their principals, and if this long-term capital gains tax passes, they will buy and hold. And so now you start thinking about, we're already inventory wise way, way, way underwater. Some people are talking about lowest in 25 years. I've heard a number as high as 10 million homes underwater based on millennials and other groups that are coming in and buying homes. And so you start thinking about that. It could create a bit of a shortage where that real estate isn't being recycled, at least over the next 3 to 4 years, which is part of the argument I'm hearing, Tony, that may get to the right people in Congress to maybe push that particular part of the code aside. I do think that could have a much larger impact. It's not going to be a tax revenue source because the big boys aren't going to sell their properties.
No, and remember that most people, the general public, right? So we're talking about all 50 states. We're not just talking about California. The general public across the U.S. holds most of their retirement in real estate, mainly their primary residence, right? So the Section 121 exclusion will still be the $500,000, $250,000 per individual, but every dollar above that may be subject to the higher long-term capital gain. There is no phase out for that Section 121 exclusion. But remember that a lot of people don't have 401ks and IRAs, they have rental investments. So all of a sudden you have this crazy situation where you have people who have a ton of real estate and all of their money in retirement is just cash flow from this real estate, and they've built their wealth in real estate and they want to leave it for their children, take the stepped up base benefit and everything. If they start changing this tax code, sure, it might generate, I think the projected amount was $110 billion over a decade for the federal government. And so my train of thought is, okay, well, I understand that they're going to need to pay for all of the money they've been cutting checks for, right? Over the past year, more money has been spent by the federal government than ever before in the history of our country. So somebody's got to pay all of that back, right? Because we do owe money to other countries. And let's just face it, I feel like California and the federal government are always in debt. I heard that we have a surplus in California. I don't know if that's true or not. I just heard that. It was a kind of a strange comment on TV. But $110 billion to me is really not that. I mean, I'm going to say it's a lot of money, but on the federal side, I just don't feel like that's a lot over a decade. And so, you're talking about taxing people over $400,000. I think the capital gain was going to change actually at about $520,000 or so. If you're single, about $620,000 married filing joint. So if those are the thresholds, okay, I understand a little bit more of where they're coming from, because already the highest income bracket, 37% currently, 39.6% under the proposed changes. But the amount of money that it's going to generate, really, to me, sure, 110 billion might seem like a lot, but when you're talking about bringing an economy out of where we are at right now and paying back all of the money that the government has printed over the last year, I just don't feel like that's a significant enough change. And then also getting rid of, or potentially getting rid of, which we'll talk about next, I assume, the exchange side of things that creates billions and billions of dollars in revenue. I think, 400, 500,000 jobs for the US or something. I mean, it's a crazy statistic. Why would you get rid of something like that when it generates money for the US economy, right? It might not be generating tax revenue, but it generates money for the US economy. And to me, that's a lot more important than us paying more tax, personally.
Well, before we go to questions, touch on the 1031, because that's the other biggie, right? So you got the capital gains, you got the 1031, which has acted as a protector, or kicking the can down the alley, or wealth builder, retirement forum, whatever you want to call it. What potential changes are you hearing there?
I did want to, because this morning I pulled up current statistics, so I didn't want to look at this really quick. 568,000 jobs in the exchange industry, 568,000 jobs in the US economy who work within the exchange industry, right? I mean, those numbers speak worlds to all of us, or should, generating over $55 billion annually in tax revenue, right? Or taxable revenue. And in addition to 27.5 billion in labor income. So you're talking about, okay, so they want to tax us higher on the capital gain, but they want to get rid of the exchange industry completely, or whatever they're going to do, phase in, phase out, whatever they're going to decide to do. They're getting rid of what, 70, $80 billion in taxable revenue, and taxing people higher on capital gain and generating 110 billion. See, to me, the numbers just don't add up. And that's why I think that a lot of this is seriously speculation. It's an idea that's being thrown out, which is crazy. It's creating a lot of fear, a lot of uncertainty in the future of the real estate industry and the market. And people are making, once again, rash decisions. But 568,000 jobs. Could you imagine losing an industry that creates that many jobs and that much wealth for the United States economy, which also is revenue that the federal government tax? Why would you cut your nose off to spite your face? It just absolutely blows my mind. But I don't think that will happen. Their whole part of this is because they feel like a lot of the properties that are currently owned or being exchanged by family members or inherited by family members, they're being underutilized and underinvested. Those are the two terms that they use in this article that was released just a couple of days ago. So I pulled the current stats from this. Nothing has passed. It is all fear. It's all speculation at the moment. But if that does change, you're going to see a lot of people, readjusting their real estate portfolios, and probably even starting to add children to title, just so that the estate exemption doesn't kick in and hit them if their values, if they're single, over 11.3 million, if they're married, filing joint, over 23 million. So, this year could be very interesting. We have 6 months left in the year, coming out of a very already interesting time in all of our lives, 2020. You could see a lot of movement in the real estate industry over the next 6 months, depending on where the dust lands around this proposed tax legislation.
I agree with that. Gina, I know we got about 12 minutes, and you probably got a number of questions. So
I do.
why don't we open them up for that and then see how time plays out at the 9 o'clock
Okay.
stop.
We definitely have a lot of questions, so I'm just going to jump in. A lot of them came up during the entity conversation, so I'm going to kind of topic-wise, I'm going to focus on those first. So first one, and I'm going to try to paraphrase this as best as I can to make it beneficial for everybody. If you have W-2 jobs and you have rentals under an LLC, if you start flipping and you're headed to more than 3 per year, where does that put somebody as far as an entity type that would be best for them?
So rentals should stay in your LLCs. W-2, if you have a full-time job working at a 9-to-5 job or whatever you're doing, that's completely separate. That's your earned employed income. That really has no bearing on the flipping business. I have clients who have 4 or 5 jobs, right? They've got their day trading, they've got their W-2 job, they've got their rental properties, and they manage their own properties. And then they're trying to flip these properties, just hard American tax-paying citizen workers, right? So you've got this group of individuals who has all of these lines in the water, so to speak, these revenue streams. And the average liquid millionaire has about 7 streams of revenue. Just that's not a common thing that people talk about, but that tends to be the amount of revenue streams that people have, whether it be rental properties or flipping properties or brokerage accounts, retirement accounts, 7 streams of revenue. So when you flip properties, though, if you are on track to flip 3 or more properties within a year, all of those other revenue streams have no bearing on the S corporation structure needing to be set up and in place to reduce, once again, Social Security and Medicare tax on the property dealer status. Now, there's a good chance that you could fly under the radar. The government's not going to come down off their high horse and say, hey, listen, you've made $60,000 in short-term profit on 4 flips this year. We're going to force you to pay Social Security and Medicare. The fear in this, though, is that as years go by and you start to move further away from your employed job and more into the real estate realm, that 3 or 4 years pass and you don't pay yourself a reasonable salary out of this property dealer kind of entity. And if the government audits that and finds that this is active income for you and you haven't been paying your self-employment tax, at the end of the day, this might be one of those triggers where the government says, no, I'm sorry, we're gonna have to go back and take 3 or 4 years into account of you having to pay 15.3% plus penalties and interest on all of the money that you didn't contribute, once again, to Social Security, Medicare on.
But
So
if I heard you right, though,
That's
the S corp for over 3, you keep your rentals in your LLC, you pay yourself a reasonable salary, and that allows you also to flow any other expenses that you're incurring in your day-to-day through the corp.
That is correct. That is correct. And also remember that if you're already maxing out Social Security, Medicare on or Social Security, Medicare doesn't really max out, but if you're already maxing out Social Security on your W-2 job, the one that you currently have, not your flipped income, when you pay yourself a W-2, you've already contributed the max on the employee side. So on the corporation side, you're actually cutting your payroll tax almost in half because you've already paid your max through your current employed position. So once again, very unique situations. I don't want to confuse anybody, but there is definitely a benefit for still doing that, especially, get this, if your employer doesn't offer you health benefits or retirement benefits. Now your property flipping business can set up IRAs, 401ks, self-employed health insurance plans, FSAs, HSAs. You can put your children on payroll, max out their deferred retirement plans, emancipate them. And when they graduate from college, they have earned income tax returns readily available to buy and finance real estate. I mean, you're talking about a number of benefits on the self-employed side of things. And once again, these self-employed benefits have been around for more than 50, 60 years. They've been around for a very long time. So it just opens up a whole world for new deductions and new planning and planning strategies.
okay. And in that answer, you answered another question, which was, for an S corp, do you have to pay yourself a reasonable salary? And what happens if you don't? So if what I'm hearing is correct, it flags you for an audit if you aren't abiding by that.
Now, remember, if you're showing a loss, no salary is needed. You can't squeeze juice from a turnip, right? So the government's not going to expect you, if you have profit under $1,000 under an S corporation, to also pay yourself a salary. So if you have profit over $1,000, yes, you tend to want to put yourself on some sort of payroll. Once again, barring a couple very unique situations, but any sort of net revenue through an S corporation would warrant a reasonable salary requirement payout.
Okay. And speaking of the different revenue streams, we have on this call right now someone who may be a broker who is also investing in real estate themselves. So one of the questions that came through was, as a broker, I also started a single member entity. Would I need to start another entity if I want to start investing in real estate? And I think that could apply in many scenarios.
So you don't want to, I was told very early in my real estate investing career, in my career in the tax industry, gosh, well before I even probably knew very much about business, you always heard the term or the phrase, don't put all of your eggs in one basket, right? So when you take that phrase and you apply it to the tax world or the tax industry, you don't want to take a brokerage business and also acquire real estate under the same entity. And once again, I'm kind of maybe not answering the question directly. I'll get to the main answer in a second here. But you don't want to put real estate and brokerage income in the same thing, just like you wouldn't want to put realtor income in the same entity as your rental income. Even though they're real estate related more than just a couple ways, they are two different types of revenue. One is self-employed earned income. The other is non-passive or passive income, not subject to self-employment tax. So once again, rental investments, the asset itself is the largest asset. It's a large asset, depreciating asset, largest asset that you and I will ever own in our lifetime, right? So LLCs are meant to protect large depreciable assets. You don't pay self-employment tax. Every other type of revenue stream that is self-employed, and once again, different in industry, just looking at the different types of industries, you want to separate those revenue streams out as much as possible to give them their individual asset protection benefit. Sure, California is going to charge you filing fees for all of those entities, but if you have those many revenue streams, you have a lot of risk because you're diversifying your overall business portfolio. And so just from a risk factor, you probably want to have these entities in place. And if you're just getting into the rental property acquisition side of things, you haven't even purchased your first property, don't incorporate right now. Don't hit yourself with all of these miscellaneous charges if you haven't even closed on your first property yet. For your real estate or realtor business, yeah, an S corporation might be warranted. For your brokerage business, it might be warranted to have an LLC or an S corporation, but don't start the entity before the ball gets rolling, before the actual profit is being made, because at that point it just becomes a cost to you. Sure, you get great asset protection, but it's got to make sense not only from a legal standpoint, but it's also got to also make sense from a tax or financial perspective as well. So I don't know if did that answer
Yes.
that question? Yeah. Okay.
Yeah, absolutely. And you touched on something that's kind of a crossover between you and Bill, which is in general a risk factor. So a couple of the questions that had come through is when it comes to private money lending, why is it that more favorable terms are extended when a borrower is investing as an entity? Bill, do you want to touch on that from a risk factor standpoint?
Well, from a pricing standpoint, I think the market recognizes entities differently because it's one more layer away from consumer protection consumer lending, which has consumer protection laws, the CFPB, and there's a whole rash of reasons there. It also, as Tony pointed out earlier, it does protect the investor. So both capital markets, Wall Street conduits, entities, and purchasers of loans, as well as us, we do actually allow our investors to benefit in price. It's not significant, Gina, but it's enough to make a difference. And I think like right now, we're running about between 80 and 85% of all the loans we do are done through an entity.
Absolutely. Another question is, as an investor gradually builds a real estate portfolio, what would you say, Tony, is the most important thing that an investor should be doing to protect their real estate wealth as their portfolio continues to grow?
Well, keep an eye on the cash flow, keep an eye on the depreciation. Always look for, I get this question a lot. I have very low debt on my property. Depreciation is kind of coming, winding down after owning the property for 27 and a half years. How can I further reduce the taxable income once depreciation is exhausted, once I've paid off the debt? And there are very few scenarios where you can just do something aside from just spending money. I don't want you to just go out and spend money or make unnecessary improvements to properties to reduce liability, right? Because every dollar that you spend doesn't save you a dollar in tax. It's just a dollar of revenue you're not paying tax on. So whatever your tax rate is, let's call it 35% federal and state, a dollar spent saves you 35 cents on the dollar. Okay, that's a great return on investment, but by no means do I want you to go out and spend a dollar just to save 35 cents in tax. Same goes for mortgage interest. Why would you ever, this was a silly question, but I get this sometimes. Should I opt for a higher interest rate because it's going to save me more tax? Absolutely not. That's the silliest comment I hear in my industry, but I've heard it before because people get caught up in this whole thing where they want to pay less tax. And I totally get that. But at the end of the day, if you have great investments that are cash flowing like crazy, really the only true way to reduce further that liability or further that income is to acquire more real estate, right? One very unique situation could be a cost segregation analysis that allows you to kind of reach into future years, grab future depreciation and accelerate it. But once again, if your building's fully depreciated, there's very little that you can reach into the future and grab. But if you've only owned the property for maybe 5 or 6 years, you're looking to free up some cash, you want to pay less overall tax to put that tax savings as a down payment on another property, a cost segregation analysis would be a great idea in that case, depending on what, how the numbers play out. But a cost seg analysis would allow you to reach forward into future years, grab future depreciation, accelerate it to take it in this year, pay less tax. With that money, the goal is to use that money to buy more property or to improve your property so that you can increase rents and equally increasing cash flow. So there's a number of situations where people kind of come to a crossroads. They're like, well, what do I do now? Because I have it paid off. I have no more depreciation. And that is a very unique position to be in. I call it the power position, right? It's a problem, but it's a great problem to have. And so at that point, the strategy changes a little bit. That's where we start to talk about tapping into equity, but also figuring out goals for the investor. Do you want to own more property? Do you want to exchange this property into a Delaware statutory trust or a syndication and just kind of let the properties manage themselves? You just collect a paycheck or see that money deposited every month into your bank account. So everybody's situation is different. That's why the plan is different for everyone. But don't feel like, if you feel like you've hit a roadblock and you're just not getting the correct advice, there is always an option, always an option. It just depends on whether or not you want to, at this point in your life, at this point in your career, want to exercise that option. I've had clients say, listen, I've owned these properties for, my whole lifetime. I don't really want to buy any more property. I guess it kind of is what it is. And at that point, we talk about, the management side of the properties, right? Okay, well, if you're in retirement, let's go ahead and put you as a manager of the property, allowing you to deduct some of your daily operational costs. And at the end of the day, not showing any profit through your management company, but through your own management setup business. But that's also another strategy to help further reduce it. But once again, very, very unique situations where that would be actually a good strategy to put in place.
Excellent. Well, I will say we have a lot more questions, and I am sorry we were not able to get to all of them, but just with respect to everybody's time, we are at time. And with that being said, many questions have come in. How can I get in touch with Tony? So I will tell you, you can contact him directly via email to set up a private consultation. His email address, and I will also send this through in our follow-up email along with a copy of the recording from today. You can email Tony directly at tonywatson@roberthalltaxes.com. And with that, Bill, can I pass to you for final send off?
I think everyone could see why Tony's so wonderful. It's like I've been paying taxes for decades, and I think I have a pretty good idea of the code. And every single time I listen to him speak or get to talk to him one-on-one, I walk away going, oh my God, I got to rethink this strategy. And so thank you, Tony. I'm sure this won't be the last time. I got 3 more subjects that I think I got to draw you back in on, but I do appreciate you sharing your wisdom in a way that was easy for us to understand, and appreciate you being open to taking all the other questions that are coming down the pike for you.
Can I mention one thing? I just want to tell everybody, and I know that there's a lot of people listening in today. We've heard a lot of misinformation over the past year, right? A lot of people fearing what's kind of coming about, but I focused mainly on why the general public really, last year at least, I really focused on why the general public really dislikes corporate America, because that tends to be the sentiment, maybe just here in California, maybe not in all states, but here in California, it's always like hate big business. And for the most part, what we all have to understand is that when you have an Amazon or when you have a Google, they employ tens of thousands, if not hundreds of thousands of employees, right? All of those individuals pay income tax here in the US. And so naturally the tax code from its inception has always been built to benefit businesses of all sizes, all self-employed businesses, because they know that businesses generate revenue, they generate jobs for the US economy. And what helps our economy grow is when more cash circulates within our pockets, right? Where it trades hands. And so for this new tax code, my hopes and wishes are that they're not going to get rid of industries, but they'll probably improve or fine tune things. We've heard, once again, a lot of fear, a lot of speculation, which has caused people to really have a serious disdain for corporate America. Well, remember that the tax code was written the exact same way for them as it was written for us. And so what you have to kind of train yourself to think is that I might not be making $100 billion yet, right? I might not be making $100 billion yet, but how do I take all of those corporate America benefits, right? The ones that people really despise corporate America for taking advantage of, and how do I apply it to my own financial world? Because Because I can tell you right now that a small business to the government is anything under 10 million bucks. And if you're thinking about small business benefits, I mean, to me, making $8 million a year sounds good to me, right? And if the government's going to still consider me to be a small business at that level of income, game on, right? But train yourself to think differently, not to despise things that happen, but how do I get that benefit for myself? And one main thing is to work with like-minded individuals like Civic Financial and Robert Hall and Associates. So I'll leave you with that.
Thank you.
That was the perfect send off. Thank you so much again, Tony. You are a wealth of knowledge and a treat for all of us. Thank you everybody for joining, all of our industry insiders out there. And thank you, Bill, for continuing this month over month. And we will look forward to seeing everybody next time. Have a good day.
Go get them.